Hi, everybody. This is Seth Martin, your host, and welcome to this week's Middle Class Investor. Well, we had another kind of up and down, but mostly up week, I guess, in the market. I've got what I've got up on the screen right here is a chart of the 10-year Treasury. I believe this market tends to, or it continues to be, an important indicator of what we've got coming our way. And you can see that we had after our strong week, this big white candle that's right here that we had a little bit of a pullback. Might even get a little bit more pullback and then resume higher. But it's looking to me like this first move up in this market does appear to be the first move up. Now, we won't know for sure until this takes out this previous high here. When it takes out kind of this zone, I guess what I need to do is put a resistance box up here, kind of a box like one of these. But once it takes that out, then we can say that this is definitely a long-term trend reversal. What we would refer to as a primary trend reversal, which means significant. Let's look at the S&P 500. As you know, we continue to look at this wedge. Let me zoom in on the wedge a little bit. The interesting thing here is we had our resistance box up here. Let me zoom in on that. So we had our resistance box there, and lo and behold, it looks like it maybe touched it and then sold off. So we'll see how that goes. It might have sold off and then maybe come back up into it next week. We'll just have to wait and see what happens there. But it is interesting how, the market can come right up and touch a little box. I mean, I just arbitrarily drew this box on here. There's no scientific method to that. It's just kind of eyeballing the previous high and making the box above that. So it's really more a function of picking the important high or low. So like, for example, this low right here is important, and you can see we put a box right here below it. Technically, I could take this one off because it's already come into that box. It could come into that again, but I think it's more likely to go past it. It tends to, if you look at these swings, you can kind of see a swing from here to there to here to here to here. So what tends to happen is the market will swing. In this case, it swung way past this high right here. So it ran up, pulled back, and then I would have had a box like right in here. And what it did, looks like really, is kind of went into the box, went sideways for a week, and then went through the box, and then pulled back. So it's really about picking the important highs and lows in the swing, out of the swings. You can see out of this swing, pretty much came into this box and then pulled back. So that's kind of what we look for, or what I look for, as I'm looking at the swings in the market. Again, there's nothing scientific about it. It's just how the market tends to move. So let's back out of this and go look at. We can look at the Euro US dollar. That continues to sell off. We talked about we had this spot here, and we had drawn a couple of boxes. There was a box here, and then we drew another box here, and it's slowly, the next area that it might stop. And of course, I'm drawing these on here, but I'm really saying this is a logical place for it to stop. It doesn't mean that it has to stop there. It's just a place that it could stop. And if it does stop here, it'll probably bounce, kind of zigzag its way up, and give us another look before it makes its next move in some direction. So let's say, for example, let's say it did come down here and stop. Well, then what we'd expect is probably a pretty strong initial move, and then something like that. So you get a lot of this move retraced here. That's pretty typical. Another possibility I see here is you could come up to about this area, come down and actually make another low. So you'd have a box off of this low, kind of a support zone here, and then come up really hard to about there, and probably up in there. If you notice, I'm drawing these, but this is the way the market moves. If you look at these swings, this is how it moves. It looks like a saw blade, and so that's why I draw it like that. Hopefully you'll get used to looking at that and can begin to see some of that yourself. That's my hope, is that you guys get comfortable looking at the market and not being as emotional about it. It's tough to not be emotional. If you have a large account and you lost $100,000, it's hard not to be emotional about that. But if you can kind of learn that the market doesn't go straight down and it doesn't go straight up, then you can maybe kind of step back and just look at the price action without looking at your account value and make good decisions. I mean, that's really what we want to try to do. Well, the volatility, it looks like our line, for the most part, held. It looks like it kind of cracked through it a little bit, which is, that happens. But isn't that interesting? I mean, I don't know how long I've had this line on here, but I think I drew it maybe after this low right here. But isn't it interesting how it came down, touched that line, and started to pull back up? Now, it could come back and, I mean, this, again, nothing magic about this line. It's just visually how it's a way to think about the buying and selling that's taking place in the market visually. That's really what technical analysis is. These support and resistance areas, these trend lines, they mean something to buyers and sellers, and they react to them. And that's why the price of the VIX could come all the way down here, pierce it slightly, and then recoil back upwards. It's because a bunch of other people are looking at these same lines. So anyway, that's the VIX. Let's look at gold. Tonight there's a couple of charts I wanted to show you that are more like marketing looking charts, but there's a couple of ideas that I want to convey here. We've been talking about, let me go back to the S&P real quick. We've been talking about our rising wedge for some time now, and it's getting very long in the tooth. The market appears to be struggling a great deal in this area. And in fact, let me get out of this and zoom in, just using the charting tool. So I can zoom in. Well, can't zoom in quite enough. So, I just want to show you, I just want to look here for a second and look at how much time we've spent really just in, if you kind of draw a box around this, we've spent 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 weeks in this zone or slightly below this zone. So this is an area that traders are having a real difficult time dealing with. And eventually you get exhaustion in these kinds of moves. And I've talked about this before, but that's what happens as the market bounces back and forth in this channel. The opportunity to make money gets narrower and narrower and narrower, and it creates exhaustion in the market between the buyers and sellers. And this is ultimately what causes the market to correct, or in this case we're expecting a fairly large correction, because the way you measure this rising wedge, and I've talked about it before, is you go back to the start of it, and that's a little bit arbitrary too. Where does it start? But it starts, basically it starts here at the low. So you take the distance between this value here, which is 671, and this value here, which is 1060, And you're looking at a pretty sizable move there, about 400 points. So we can expect the let me go back to a 5-year weekly chart. We can expect this to be a pretty sizable move, something down into the 1650 area. And I'm guessing, now again, doesn't go straight down, but I'm guessing that most of you guys are not interested in taking that kind of loss in your 401k or IRA. And so that's what we're here to talk about, to hopefully keep that from happening. So we've talked about, and maybe it's good to review that now. We've talked a little bit about the psychology. How is it possible? I mean, how can you, Seth Martin, say that that's likely to happen? To me, a 401k, owner. And I was telling you that, what happens is the market moves down and it moves back. And right here you say, oh, well, it'll come back. And so it does, but it makes a lower high. But people don't notice it because the news isn't really talking about it. And it starts to do this, and nobody knows that it made a lower high. And then it comes down and it does one of these deals pretty far down here. In the news, you start hearing about it, in this area, maybe even down here. And you say, well, it's going to come back, and maybe you get a pretty good, trace back up, and you say, hey, I knew it would come back. But then right about here, it makes, notice the highs are getting lower. Okay. There's a lower high and a lower high. Here's a lower high. And of course, here's a lower low and a lower low. So, rationally, people aren't looking at the market like this as a series of lower lows and lower highs. The news just says the market was up on, news that we were going to go back into Iraq or whatever it says. It doesn't matter what it says. And nobody notices that this was a lower high from this low. And usually around the second or third or fourth retest, you get a pretty substantial move. I mean, one that's you can consider breathtaking. And so this is what I'm talking about, the psychology of it. Oh, it'll come back, and it does come back. So it comes back, and you go, hey, I was right. See, I'm glad I didn't sell down here. But then this next move is the one that really gets you, and of course causes you to lose a lot of money. And that's how the psychology of the market works, and ensnares you in its little cruel game of stealing your money. So let's look at the Dow. We didn't look at the Dow, and then we'll go to these other charts. I'll look at gold, and then we'll go to these marketing-looking charts that I was talking about. Now on the Dow, we really haven't been using our support lines and resistance lines, or boxes, but you can see that this is about the place where you would put one, right? Just above this high, right in here. And of course the Dow is well into that resistance box. So even if this doesn't become the sell-off, I think you'll see the Dow and the S&P. The S&P might go a little higher because it's barely into the box, but the Dow, I think you'll see the Dow and S&P next week start to move a little lower. Maybe get something that looks a lot like this one. So let's look at gold real quick. I got gold up here. Let's see if I can get more of the chart on the screen here. I shouldn't have done that. That's going to mess things up. Yep. Sorry about that. So let's see. The edge of the recording is over here. So, back in 2011, gold peaked. It made a low. It made a lower high. And then you had this massive sell-off. And then it's been consolidating. And I think last week or maybe the week before, I drew this line, this 1238.50 line. And I said if it broke this line, that would be the start of the next move down. So that's more or less what we're getting here. It broke that line really the week before last, but it closed this week below the line. So a lot of times what will happen is you'll get it'll come down here and then maybe come up and retest the underside of this bottom part of the triangle and then go lower. And I think you can see gold, around 1,000, maybe even slightly lower than 1,000. We'll just have to watch it and see. But if you're thinking about buying gold, you might want to wait until at least gets below this 1,100 area. Save yourself $150 or so. So what is the nasty little thing that's causing all this change in the market around gold and interest rates and so on and so forth? Well, how about the U.S. dollar? The U.S. dollar is on a tear. This is a weekly chart of the U.S. dollar. You can see that for some time, the dollar, it made a low down here back in 2011. We've talked about this before. About the same time, gold made a high. So it makes sense that the dollar, is basically an inverse picture of gold. Okay, so I would expect the dollar to make a new high here. It's not showing a closing high, which is why this high is not over here, but it is a high. That's interesting why it's not showing that. This really should be the new high, but I guess the tip of that is actually higher than this close. So the dollar looks like it's on a pretty impulsive move up, and I would expect the dollar to go a little bit higher here before it corrects. And basically, you can look at the dollar or you can look at gold. They're going to track one another, I think, is pretty closely. This actually, everybody, in case you don't know, this is a sign of deflation. Also, what's happening in gold is a sign of deflation. So what is deflation? I'm not sure. We've got varying degrees of what people know and what they don't know out here in the audience. But deflation is basically a shrinking, it's actually a strengthening of the value of your money. Inflation is increasing the money supply, which then devalues your purchasing power. Deflation actually strengthens your purchasing power. And oddly enough, our government officials and banking people and the media, they all talk about inflation as it's a bad boogeyman, and deflation as if it's a bad boogeyman, and it's harmful to the economy and so on and so forth. If you actually go back and study American history and economics and history, you'll find that some of the greatest growth periods in American history were in deflationary periods. So it's just the real reason that the government likes inflation and the media talks about inflation and people are saying we need, inflation's better than deflation and all that. The real reason is because the government uses inflation to make its debts worth less money in the future. So it gets to spend money today, so it gets to spend $1 today, but it gets to pay that dollar back in the future when it's worth less money. And that the government benefits from that. Of course, you and me, we don't benefit from that. In fact, that's what makes prices rise over time, is basically the devaluing of the money. So the fact that you're going to hear all kinds of negative news about how this is awful, that the dollar is going up and it's going to hurt our exports and it's going to hurt our economy. Look, this is going to be good for you individually. It's going to cause your prices to come down. It should cause food prices to come down. Meat prices, I'm sure y'all have seen all that go higher. And most people in the economy are on the wrong side of this trade. So you're going to hear a lot of misinformation around the dollar and this deflation and stuff. So just want to give you a heads up on that. Real quick, let me pull up. I just want to pull up some charts that I want to show you and talk about here for a second. Just as you see here, this is bank debt is now growing 30 times faster than our economy is growing. So you can see this started back in 2008 when we had the financial crisis. Basically, we have what's referred to as a debt economy. So every dollar that's in existence is borrowed into existence by the Treasury via the Fed. So, I'm not going to get into how that actually works, but basically, the economy grows into a debt bubble. This is maybe where the term bubble came from. I don't know, but as the debt expands, the total debt, and that includes government debt, that includes personal debt, business debt, all debt. As that debt expands, the economy grows into that debt. Now, if you have massive waves of default, i.e., debt that can't be repaid, then what happens is the economy shrinks. You have a depression or a deflationary cycle in the economy. And this happens over and over again. The scary thing about right now is the debt is so big, not just the public debt, but the private debt, business debt, debt everywhere. It's so big now that the deflationary cycle that we could be heading for, if you look at the dollar, could be significant. So I just want to show you a few charts that help kind of explain that. So the actual bank debt is growing 30 times faster than our economy. Now, some of this is derivative debt. So, these banks buy foreign bonds and then they sell derivatives against those bonds to kind of boost their revenues and things like that. So, which is really bad. I mean, if some of those bonds start going bad and they start having to delever this, it could happen, pretty rapidly. And basically, you just have a massive amount of money disappearing from the economy. And here's just another. The American banking system has over $60 trillion in debt, and I don't think this includes derivatives. I think this is just straight away debt. Now, what's interesting here, you'll hear about people that are called gold bugs. People that are gold bugs are people that believe that gold our money should be backed by gold because you actually have to dig it out of the ground. You have to refine it. It takes real work to produce gold and therefore constrains the government. And I believe that is an accurate statement. But what's interesting is here, the gold window was officially closed in 1975 right here. And you can just see how much debt has been created since 1975. So basically, you could say that since 1975, we've really had a kind of a phony economy. Now, it's not phony in the sense that we're all living our lives and things like that, but it's phony in the sense that it could all go away. I mean, we could actually, let's say a big chunk of this debt gets whacked right here, at this point. Well, all this debt here would show up in reduction of salaries. It would show up in defaults of people's homes. It would show up in it would wreak all kinds of havoc in the economy. So, obviously that's not good if that happens, but, this debt, this is why the gold system really constrains the government. And, it was supposed to be that way in the 40s after World War II, during Bretton Woods Conference. We agreed, everybody in the world agreed to use the dollar as the reserve currency of the world. But that was because the dollar was backed by gold. So, some 30 years later, that was 1945, 30 years later, we said it was temporary. We said, hey, we're closing the gold window. Nixon said it was temporary. Of course, it wasn't temporary. And you can see how unconstrained the government became after that. So I think this is a pretty telling chart. This is another chart that's, I don't know, it's easier to maybe think of this in terms of your own personal finances. Think of this as this red down here, this $56.2 billion. This is what the Fed actually has in assets on its balance sheet. In other words, these are assets that the Fed owns. And the liabilities that the Fed has are $4.3 trillion. So think about that. Like if you had, it'd be like you having, I don't know, $56,000 in income. Think of it in terms of income. But you had $4.5 million in liabilities or loans or something. It's that kind of ratio. It's that kind of difference. So this is pretty substantial, and the idea is that the dollar goes up sooner and interest rates go up sooner than the Fed thinks. See, the Fed doesn't set interest rates. The Fed follows interest rates. The 10-year Treasury is the most important market for interest rates, and that's a market. It's not the Fed manipulated. Now, the Fed has been manipulated by buying bonds, but traditionally that market is set by buyers and sellers of bonds in the open market. And then the Fed follows those rates by raising and lowering short-term interest rates, mainly for the purposes of controlling money in and out of the banking system. So, but you can imagine if interest rates go up faster than the Fed is expecting them to, they've got huge liabilities here they're going to have to deal with, and nobody really knows how that's going to happen. Here's another explanation of debt and how it's affected our economy. In post-World War II, 1950s and 60s, for every dollar that the U.S. Treasury borrowed, the United States government, the United States market economy, produced $2.41 of GDP. So let me say that again. For every dollar that we borrowed, not just the government, but across all sectors, personal, government, business, for every dollar that was borrowed, we produced $2.41 of GDP. In the 70s and early 80s, for every dollar that we borrowed as a nation, we generated 41 cents of GDP. And of course, right now, for every dollar that we borrow as a country, we're only generating 3 cents in GDP. Now, this is where all your jobs are going, okay? This debt has an inverse relationship to job growth, to economic activity in general. And people like, what's the economist's name that's always in the New York Times writing articles? He says, no, we should be spending more money. The government should be borrowing more money, should be running higher deficits. I mean, this guy is just wrong. I don't know how he won a Nobel Prize for economics. He's just not right. Don't listen to that guy. So anyway, that's an interesting chart. Let's see. Here's another interesting chart. Global GDP is $72.6 trillion annually. But the global derivatives market is $710 trillion. Why is there a global derivatives market? Well, the reason there's a global derivatives market, and one this big anyway, is because there's no yield. Nobody's making any yield. So what they have to do is they have to buy and sell derivatives, mostly sell derivatives, in order to boost yield. So when the interest-free or the risk-free rate, which is the U.S. Treasury rate, excuse me, is 2.5%, but you're promising shareholders or investors that you can return 5 or 6%, you're going to have to do something more than just go buy the 10-year Treasury. You're going to have to sell derivatives and do some financial engineering to boost that return, and that's what's happening. That's what this 700 trillion is. And a lot of times what happens is the market can move really fast against these guys, and they have to, it's like a fire sale in this derivative market, and then it can have a real, it's very high response action in the market. It causes a lot of turmoil, a lot of financial angst. This is the stock market cap to GDP ratio, and these are other times in our history. Right now, it's at 204%. At the top of the financial crisis, it was at 203%, and at the top of the .com bubble, it was 183%. So we're basically in that area where the market tops, and right now we're going through a time when it tops, it really goes down and goes down hard. So what we want to do here again on this program is to try to keep you out of, just have you in cash or something during this fall here, or during this fall here. Okay. Let's see if I got another chart on here. Nope, that's it for the charts. So again, we can kind of let's close by looking again at the 10-year Treasury. Again, that market is the one that I think you should be taking action on now if you haven't already. If you have bond funds in your 401k or your IRA, you need to do something else with those. And I don't really care if they're high yield bonds. If your broker says, "Oh, don't worry, these are high yield bonds. These are corporate bonds," doesn't matter. Okay, this interest rate is going to wipe those bonds completely out, and you don't want to be in the bond market. Period. Which begs the question, what do you get into? Well, I was talking to my father-in-law the other day. The dollar is on its way up. You could look at that. You could look at the interest rate market, the TBT. This is going to continue to move up as yields rise. You could look at going opposite the market. You could look at something like the SDS. Let me get this off here. This is a double short. So as the market goes down, like I guess the market was flat the other day, basically ended the day flat. But if the market goes up 1%, this goes down 2%. If the market goes down 10%, this goes up 20%. So it's called the SDS. And there's a bunch of, you can just look at ETFs, and you can pull up on Google and look up ETFs. There's a whole bunch of ETFs. And there's a lot of things you can invest in. So, I'm not really here to tell you what to invest in. That's not the goal of this program. The goal of this program is to keep you off the tracks when the train starts barreling down. So, if you need help with that, you need to seek out help. You can ask questions in the comment section on the YouTube channel if you like, and if I feel comfortable in answering them, I'll answer them. If not, I'll tell you where you might go to find the answers. But every person's situation is unique. People are different ages. They have different, all kinds of different goals. It's just very difficult to tell people, buy this and you'll be fine. That just doesn't work. So anyway, that's it for this week, guys. Just again, forward the link to your friends, your family members. Tell them about Twitter @InvestorClass, or you can find me on Middle Class Investor on YouTube. And we'll keep coming in here and doing these videos, and hopefully, keep you out of trouble. That's what we're trying to do here. So until next week, we'll see you guys later. Have a great week, and God bless everybody. Bye-bye.